Morning, everybody. It's my great privilege and pleasure to have Richard Hargreaves online this morning. Richard brings with him 50 years experience in building and investing into ventures, mostly technology ventures, I believe. And so during this fireside chat we've got for you this morning, we'll be picking up on some quite interesting points and drawing on his considerable, if not extensive, experience in this field. Before we do that, I'd like to introduce the book that we are using for this webinar this morning, which has been written by Richard, called, of course, Business Angel Investing. And it is a remarkable document. I have said that it's a handbook. It's one that should be at the side of every angel investor and any leading technology venture CEO. So first off, then, we have the book, which is divided into 5 parts, angel investing. And we are this morning going to be going through a point and focusing on should I be an angel? And then the second part, investment opportunities and terms, which is in fact chapter 4 in the book. We'll be talking more about how do I find investment opportunities? One of the things that Richard has said is pretty defining in a career to build a super portfolio as an angel. We'll then move through the next section and come to the end, but what it has in the book it says, should I actively be involved with my investments? It is extremely comprehensive. And it has 14 chapters within it to be able to cover off the subjects that we're going to cover this morning. And we're going to finish off this morning on the exit. As you will all know, being involved in a successful exit is very, very important for the entire process to complete. And for many angel investors to then reinvest some of the upside that they've achieved. So a comprehensive morning for you. The book's available on Amazon, and I think you'll find it utterly compelling. I've read the book from cover to cover. I have found it totally compelling. So let's see what we can bring on to you this morning through this fireside chat. Before I do that, though, just wanted to say the book contains 42 case studies. It also has Richard's points to note on every case study. And that's really intriguing because sometimes the case study will then say, lead you into a train of thought, but you get Richard's conclusions from that as well, which I think is really good. There's an amazing glossary section in the back. So if you're not up to date on the 135 key terms associated with angel investing, that's a great place to go. And of course, the book has an amazing index at the back. So I'd now like to change tack slightly and turn to Richard and talk to you, Richard, if I might, about the whole subject of should I be an angel? You do cite 10 rules for being an angel. And so perhaps I could hand the floor to you and just say, tell us why.
Okay. Well, the first thing to say is it's a very committed thing to do. You make an angel investment, by which I mean you invest in an unquoted company. And having made an investment in an unquoted company, there is no easy route out. There's no easy divorce clause. It's not like buying quoted shares where, fine, you might be taking a loss, but you can sell them. Mostly with an unquoted company, you are stuck there until one of two things happens. Either there's a liquidity event, the whole thing's sold, or there's an IPO which you might or might not be able to sell. And sometimes nowadays in modern venture capital world, the VC world, an investor will put 10 million into a company, say, and also offer to buy 10 million pounds worth of shares. So sometimes there's an opportunity along the road, but very seldom do you have any control over that. So you must be prepared to lock that money away for a period of time that can be lengthy. My biggest winner, which made over 100 times money, took us 14 years in total before we got all our money out. So it's just, just worth bearing in mind, this is not a quick in, quick out, which you'll often get the impression from the media that it can be. So alongside that, it must be money you're happy to lock away. You must be happy, well, happy is the wrong word. We must at least be prepared to see any one of those companies fail. And you'll see from the stats I put in the book, both quoted, published stats and my own stats, you lose most of them. You either lose them completely or they don't do particularly well. So you're looking on the better ones to make enough money to pay for the bad ones and to see an overall profit. It is also, it's sort of self-evident, but it's easy to convince yourself it isn't. You do not know which are the winners. I mean, if you knew which winners were going to be initially, you wouldn't back the bad ones, so you'd only ever have winners. And don't trust somebody who says, oh, well, I've made 5 angel investments, they've all been fantastic successes. I'm sure there's somebody out there who has, but it'll be a bit like entrepreneurs. Entrepreneurs have a big success, they then think they're God's gift. In looking forward, actually what they don't realize is how much luck was involved. And therefore, this is quoted in the book, there's actually a weak correlation between business success in business A and future success in businesses B, C, and D. The other thing I would pick out from that list is it's much better if you do things you have some understanding of. It's not saying you need to be a deep expert, but if you understand the market and how it's moving, you do get better results. I found by stopping investing in anything that came past the door that I fancied and focusing in my case, business to business software, I not only learned a lot about that market, but my results got better. And when I was investing in a company, I was in a better position to make introductions or whatever. So it's a long-term game. It's a risky game. What you're trying to do all the time is learn how to control that risk. And if you don't enjoy it, don't do it. If you start off and you hate it, you think, well, I've got no control of these companies, which you don't, then, don't do it. And my final thing I'd say on that is if you do fancy being actively involved by perhaps being a non-executive director, put your hand up and say so. Most angels, in my experience, don't. They want to make the investments. They like doing that. They want progress reports, but they don't want to be on the board. So I have found a role for myself where I've tended to lead syndicates and then act as their representative on the board.
Richard, could you pick up a little bit on some of the due diligence? You make a very good point. I referenced the 10 points that you made, and your point 7 is do some due diligence. And I think you sort of inferred that there's a sort of an element of syndication around that, finding someone that will lead it. You mentioned the term lead investor. Perhaps you could set all of that in context.
Yes. What I say elsewhere is that when you're looking for investment opportunities, probably the single best thing you can do is join an angel group, and possibly join more than one. And most of these angel groups or networks, and there are a lot of them, over 50, they won't charge you to be a client sitting there. There'll be a fee will be charged when money is invested, but it won't be charged on you. It'll be charged on the company. What I've found is that a syndicate, you'll find in the syndicate with any luck at all, there are 1 or 2 people who understand the market, and most people don't. And so the people who don't can get a lot of comfort by being involved in a conversation with that person who might not strictly be leading the syndicate, but it's a good point of reference. So you need to meet the people. Maybe you don't meet them. Of course, over the last 2 years, you wouldn't have met them physically, and maybe you don't meet them physically anyway, but having a conversation with them helps, because at the end of the day, the very, very bottom line is you're backing people here. Businesses like this, and I guess it's true of big businesses too, mostly fail because of poor management. They don't mostly fail because there's a misread of the market or something else goes wrong. So the people are very important. Again, it comes back to my earlier point. You're going to be invested with them for a long time. So for goodness sake, be comfortable with them as far as you can. A point I make somewhere in the book too is you must, if you're going to do nothing else formal, do read the company's articles of association. Do
Yes.
you know what an ordinary share is? You might think you do, but there is no such thing as a ordinary share. Ordinary share does not necessarily mean the same thing to different people. So you must read the rules. And the
Yep.
particular thing, and we'll get to it later, when you come to exit, there may be more than one class of share. There may be some rules about how the money, the total pot, is divided and gradually trickles down. You need to know how you get your money back, and how what sort of profit you might make if it's sold for 20 million, for the sake of a number. So you must at least do some extremely simple things like that.
We'll come on to the subject of waterfall in a little while, because actually I think they've got some really good ways about the subject matter around how to share out the results of a good exit. But in fact, actually, should I be an angel, in the chapter there, you also talk about portfolio development.
Yeah.
And, I think you've inferred that it's, build a number and don't expect any one of them to be a success until they become the success that you always hope. So, but I think that you also make in that section of the book the importance to be able to follow your money. Because I think somebody that's new to investing might be tempted to give their all in their initial round or the round of the company.
Yes.
So would you like to talk about that?
Yes, I would. It is, remember that I'm casting this whole thing on the assumption that you're investing in early stage businesses, not later stage businesses that are already fairly solidly established and so on. It is a good assumption, and you can learn this very quickly from even a minor amount of due diligence, that the company is likely to need more money than is being put on the table now. And it's important, actually, if money is being put on the table now, you say, oh, I'm prepared to invest 10,000 in this thing. You want to make sure the other 490,000 that they're raising is there. You want to find you're the only person who's written the check, and therefore it does pay the wages on Monday, but the business goes bust on Tuesday. So you've got to make the assumption the businesses will need more money. If you project forward a startup business, it will lose money for a period, almost inevitably. You don't give it money for 2 years, because all kinds of things could be wrong in your assessment of that business. So you give it money you collectively will give it money maybe for 9 months or a year, expecting at the end of that time a request for further money, but you'll have the knowledge of progress made during that period. So you must have money available to go in again. The problem is, if you don't, other people put money in, and if there are enough people who aren't following their money, people can get quite brutal with what the terms are. So you can find yourself disadvantaged by dilution of your equity stake. So when you're thinking, yes, I'm going to do a bit of this, I've got sort of 2 fundamental rules in the book. One is, do assume that you're going to make 10 investments at least, because you don't know which ones are going to succeed, and you're only really likely to get 1 in 10-ish very good investments. And do assume that you're going to have to put maybe double the amount you put in initially. Now, of course, when you are asked for more money, you might then say, oh, I don't like the progress here, so I won't put any more money in, I'll take my chances. But you do just need to be aware that this is it's not sort of one shot gambling. It's not like buying a lottery ticket.
That's excellent. Thank you for that. And it's you talk about knowing the sector, or knowing people that know the sector. And so that chapter is extremely comprehensive. I'd like to just move on now and talk a little bit about how do you find investments. And maybe I should say, how do you find good investments? Because there's an awful lot out there of noise. Perhaps you could dwell on that for me.
Okay. Well, I think the first thing to say as a precautionary thought is be very careful of cold approaches. I mean, because my name's around, I get loads and loads of emails from people saying, we're raising £3 million and blah, blah, blah. We got the greatest, whatever it is. I almost always simply bin those things. I don't find that a good way. It's not a good way to raise money, and I don't find it's a good way for me to be approached. So what do you do next? Well, don't just go down the pub and back the person who bought you the pint of beer. Now, of course, that person may have a brilliant business idea. And it may be an absolutely brilliant thing, but you need a broader flow of deals than that. And the commonest single thing angels will tell you about the difficulty of investing initially is they want more deal flow. So my recommendation would be you join some clubs, some angel networks. There are plenty of them around. A lot of them regional, but that's not to say you need to be in that region to be one of their clients. There are plenty in the southeast. They're scattered all over the country. And the good ones will then show you an opportunity. They have done some screening, or they wouldn't show the opportunity to their clients because they don't want to look like idiots. They probably have done some screening. They're probably giving you some sort of write-up, and they're telling you the proposed terms of investment. And they may very well, I'm just thinking of a way a particular one that I know works. They hope that particular one, every couple of weeks or so, has a little webinar, and it might have 3 lots of entrepreneurs presenting. And the way they do it is they say, you've got 10 minutes, Mr. Entrepreneur. No more than 10 minutes to put your wares on the table. They then look after that 10 minutes up, there's a chance for the people, the angels who've been watching to have a little conversation amongst themselves. And then the organizer says, well, look, what we'll do next is we'll have a 2-hour session, not a 10-minute session, 2-hour session for those that are interested in learning more. So it cuts out all the people who aren't. And hopefully in that process, you'll find that there's somebody in the group who says, hey, well, I do understand that market, and it's very interesting, but I'm a bit worried about X, Y, or Z. So you have to work at it. It won't just come, stuff will come through the door. And one of the things you'll see in the book I'm very circumspect about is crowdfunding. I regard crowdfunding as bits like selling snake oil to the unwashed. It's very dangerous.
Can I just jump in there and just say, I'd like to differentiate stakeholders slightly, saying that we're a platform investment.
Yes, no, that is it. No, and there are, of course, there's
a range there, and I think you're quite right in what you say. I agree entirely.
Yes, and linked to all of that is you, as let's assume, as a new angel, you've come from some sort of business background. You've got some spare money. You like the idea of doing this. You may think, hey, I've done rather well out of this, that, and the other in my career. I'd like to put a bit back and help some new people get their feet on the ground in terms of building a business. You just have to be so careful that you do understand what's going on. Now, a critical thing you probably won't understand is what's the appropriate valuation of the company. Now, I look at it in terms of, if the valuation is X, can I see the possibility in some sort of realistic way that in a few years' time, I might be able to make 10 times my money? If I can't see how I could possibly make 10, and I don't trust people's projections at all. So if I can't see the possibility how this thing could be worth 10 times what they're offering it to me today, I'll pass on it, because I know I need to have everything with the possibility of 10 times my money, because most things that I'm going to lose are going to lose my money. I'm going to make up a moderate amount with some, and I'm going to make 5 times, 10 times, maybe more on the occasional one. And so you really need some guidance on what's a realistic valuation. And some of the stuff you see in the media is absolute rubbish. And some of the things that people have done when the market was crazy, as it has been, were just insane, just completely insane. So you just got to keep calm and collected.
Very good. And just before we move on to the next chapter that we want to talk about, you've touched on the subject of syndicates. I understand that some research says, put forward by the British Business Angel Association, the British Business Bank, that 78% of investments in the early stage involve a syndicate of one form or another. So they are very important, and it's fair to say that stakeholders is in the process of forming its own syndicate for that very reason. So
Yeah.
And you know, out of that comes the sector expert, the lead investor, and so on. So it's a very important structure. I'd like to just move on now, Richard, if I might, to talk to you about what do you need to understand about the terms and instruments. And you've already touched on the articles of association and inferred that they're really important. So perhaps before you get there and maybe want to expand on that, you know, when do you actually invest as an angel? What's your answer? And that is a subject that you raise in your book and discuss very eloquently.
Well, there are standard sets of articles. Well, there's a standard model that is available, which is within the Companies Act. And you'll find a reasonable company has taken that standard model and maybe modified it to maybe some different rules on the shares. And there are some red flags. I mean, if you find that the founders are in a special class of ordinary share, let's call them A ordinary shares, and they get 90% of the votes, whatever happens, my advice would be don't touch it with a barge pole, because the founders now have complete power, and the money, which is after all essential to their progress, has no power at all. That would be unusual, but people do try and get away with these tricks. And I did see one where I was asked to come in as a non-executive director, and I read the rules and I said to the chairman, you do realize that the founders always get 80% of this company. So as more and more people put money in, the founders always get 80% of the company. So they're not motivated to not be raising money because it's expensive. The opposite is true. And the investors, the existing investors and the new investors are being treated really, really, really badly. Now he was able to get the rules changed, but that was, you know, some smart IT man that he thought people wouldn't read the rules. And actually, there was a broker selling this deal to his client base. He hadn't read the rules. He didn't realize. And he'd raised 2 lots of money with these rules that heavily disadvantaged investors. So you just must read the rules. When you see a set of companies article, it's full of a lot of stuff that let me call bullshit. It's not irrelevant, but how directors' meetings are conducted and stuff, that's not really where the interest lies. The first piece of interest is, what are the rules of each share class? What are its voting terms? How does it get money when the company's being sold? How is it divided amongst people? Who might have the right to appoint a director to the board? And all of that, when you've been through it, you may say, well, that's okay. Or you may say, I don't know whether that's okay or not. So you want to speak to somebody who does know about that kind of thing. But you do see alarming sets of rules put before people. So it is just important to do that. One of the attractions of the syndicate is hopefully there is a syndicate organizer in some sense or another, and the syndicate organizer is worrying about those things. So that's very helpful when you don't know what you're doing. And an angel group, an angel network, it doesn't want it to get around amongst its clients that it was being really, really sloppy and putting forward things that were unfairly, the risk was unfairly distributed amongst the shareholders.
Very good. And in fact, in that chapter, you publish what you call a deal benchmark, which is a very good list of things to go through. You reference the articles, you talk about tag along and drag along rights. And that's important when you actually come to an exit, because you then know what the process is of actually getting that deal accepted. You also talk about, seeking a founder's sensible financial commitment into the venture. You talk about agreeing salaries obviously with the C-level, C-suite and so on. You talk about good leaver and bad leaver provisions. And then you also say that the director should fill in a legal questionnaire so that you're getting a very good profile as part of your due diligence. So did you want to add to any of that?
Well, you said that's what you would expect the syndicate organizer to worry about, that pack of information.
Yeah.
You then, as a small player, don't need to worry about it. And one advantage of being involved in a deal where there is some sort of institutional player amongst the investors is that they will definitely want to go through all that. They'll want to have it gone to put through proper legal process. And of course, they're also much more experienced about pricing, valuation of the company than others might be. Now, there are issues to do with other investors who are not corporate institutional investors rather than private investors. But I mean, I've invested in quite a lot of things where there have been EIS funds invested. So they're coming in looking to be satisfying EIS rules, which most angels are going to want you to do because there are clear tax advantages in that. And I found those people by and large quite good at getting all that legal structural stuff together. They're not necessarily so good when it comes to being on the board and giving guidance, because they have a tendency to use slightly less experienced people. But at least there's some comfort from feeling somebody else there has really been crawling through the whole thing, and you're now presented with a pack of information that has been done with sensible lawyers.
So that's really interesting. Thank you, Richard. So I'm conscious slightly of time, and we've got one more chapter, the big one, to talk about. I just want to remind those online this morning to say that if you'd like to ask a question, if you put it in the chat box, which you'll see at the bottom of your screen, then that would be really helpful. And we intend to go for an open mic session if that becomes appropriate later on as well. But, you know, conscious of time, shall we talk about exits? Because that's where the business end of the whole process happens. Because if you don't get your exits, you don't get your returns, and there's no point in starting the process in the first place then. So I loved your reference to 5 liquidity events. And I also had to look at the bottom one where you put complete failure. And of course, one has to then realize that actually for angel investors that have capitalized on EIS, there is in fact the ability to crystallize your losses for tax relief. So did you want to talk about flotation, trade sale, partial sale, distress sale, and complete failure?
Yeah, yeah, well, let me just, because you talked about it there, let me just start off with complete failure. Complete failure, the company's going to finish up in administration or liquidation or whatever. And let's assume all avenues have been explored, and that is the outcome that is the best in all the circumstances. Assuming you've had your money in EIS form and the rules have been followed, you will now have the opportunity to take that loss. Remember your loss, if you put £100 in, you've claimed 30% income tax relief. So the maximum you can lose is 70. The opportunity exists to take that £70 loss and either put it against a capital gain that you haven't got, or more commonly, you put it against income tax, higher rate of tax, a much better thing to do. To do that, you must have a crystallization that the revenue will accept. Company in administration or liquidation, that's easy. Company being an absolute write-off, but not in administration or liquidation, the revenue will not accept that as a loss. Unless you chose, if you find somebody to sell your shares to for tuppence, that will be a loss, but it's not completely straightforward how you claim the loss relief. And the loss relief, when you look at your overall portfolio, your overall scorecard, as I do in the book, that sort of stuff is quite important to it. Coming up the ladder, then you have the sort of distress sale. You know, we need to sell it because it's not quite making it. Maybe times got very hard for raising money. We need more money. We can't raise money. In those circumstances, of course, on the one hand, you're going to take the shares as a whole. Are going to take what price is on the table, which may be rather poor. The trouble is the buyers also know it's a distress sale, so they're going to make rather poor offers. But if your alternative is keep pumping money in, that's not a smart thing to do. And one of the most embarrassing things I report in the book is the company, which I choose not to name, where we did actually do 14 rounds. And each time, you know, we were told a story, which we wanted to believe, that give us another 100,000 and it will all be all right on the night. And it never was all right on the night. And eventually we sort of woke up from our drug-induced coma and stop doing that. So, you know, there's a moment if you're being asked for more money, after you've got the ask, you put some money in, then you ask for another round, normal. Then you ask for another round, also quite normal. But there's a moment when you say, wait a minute, are they really making progress? Am I now just putting good money after bad? So now let's look at a trade sale. I'll come to IPO last. No, let me take IPO now first for a different reason. Very many entrepreneurs will set off saying, what we're going to do with this is blah, 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 grow it dramatically, take it public in 5 years' time, to which the simple one-word answer is rubbish. Very few companies go public. Of all the companies that you see started and grow, many of which are very good companies, don't go public for a whole pile of reasons. So it's not something that I would expect to see as the aspiration. I would expect to see as the aspiration, we're aspiring to sell it for a profit at a later date. It doesn't rule out the idea of an IPO. And if you go through IPO, you go through a very demanding process with let's assume we're talking AIM here, with the nomad, with the lawyers, with all sorts of people. That takes a long time, it's very stressful, it costs a lot of money, and it's not guaranteed. So it's possible the company goes down that track, does all the work, and the market's impossible for some reason. So there's a huge big bill to be paid. So that's dangerous. The other thing to say about IPO is not the same thing as getting all your money out. It may be, the ones I've mostly experienced have been, there was the opportunity to sell some shares at flotation, but you have to agree how many you're going to sell, and then you're not allowed to sell again for, say, 12 months. You get a lockup clause. So it's not a give you all your money kind of back situation. I mean, it can be, and I have a company that people made up to 150 times their money. One of the funds, which was a regional fund, sold out entirely on IPO, making 8 times their money, because their rules said you must sell on flotation, and they missed out on this massive multiple later on. So the IPO is something people aspire to, and it has one reason that entrepreneurs will aspire to it is you don't necessarily lose control of the business. You know, you're still chief executive, you're still building it, and so on. But it does happen comparatively rarely, so just be aware of that. So then we get to the most likely thing, which is a sale. And the most likely scenario of that is probably the complete sale. Everybody sells everything. The executives who run the business will almost certainly be given some sort of golden handcuff. Here's a service contract. You have to do 3 years. At the end of 3 years, you get a big bonus for being there. You may get a bigger bonus dependent on results, but you know, there's an incentive to stay in place. And you, the investor, comes right out. You may have, say, I'm giving you a typical sort of number. You may only get 80% of your cash up front, and the other 20% is held back for 12, 18 months in case there's something that the buyer's been told that turns out not to be true, held back against what are called warranty claims. But the trade sale is not, the sale is not, it's not the easiest thing to do. There are different kinds of buyers. There are private equity buyers who will be buying on the basis they're going to see the thing built. They might want to build it in with other companies. They will be much more likely to say, well, we buy at X times recurrent revenue, annual recurrent revenue. The most attractive buyer is the strategic buyer, the big company who says, you have got some technology, a product that we really, really want in our portfolio, and you, if it's offered to our sales team, it'll motor. So we don't really care what your results are at the moment. What we're interested in is the fact you've got this very interesting product. We can see from the customers you've got signed up that it's got customer traction. And when that happens, you can get very superior prices. But you're not, it's not something that's entirely in your control. And those kind of things can happen out of the blue. I had a company we sold 2 weeks before lockdown. which was only had revenues of about £1 million, but was growing, and it had a product that was of particular interest to the consumer feedback world in advertising and brand development and so on. And we were approached by a big American company in the media world, and they offered us 22 million for £1 million of revenue. And actually, nobody really wanted to sell, except the executive said, look, we're making sufficient money out of this that it alters our freedoms in life. So we'd like to sell it. And I was a shareholder, and I said, I think we're at a really important turning point, and we could have tremendous growth over the next 3 years. But hey, the boys wanted to sell. But that was, Bluebird coming through the window saying, hey, I'll make you an offer you can't refuse. The normal process is you as the board. And when I should have one thing I didn't say earlier, and I'll just say it now, is I do think it's extremely important that this angel group, this group of angels, even if they're not all formally connected, have somebody on the board who is sort of representing their interests, and talks to them and gives them feedback, so they have an inside track as to what is going on. But if the board decides, the board and the investors decide, let's sell this company, you're going to look around for a way of doing that, and you're probably going to finish up appointing a mergers and acquisition agent. It's like all these things, there are good ones and there are bad ones, and there are indifferent ones. And you're into a whole new stack of due diligence, which is, why should I use X rather than Y rather than Z to help us? And it's in most cases a much slower process than you think it's going to be. It's going to be, in today's world, selling technology businesses, it's 6 to 12 months, with no guarantee you're going to get an exit at the far end, and meanwhile there's lots of distraction and so on. So I think the point I'm making about all of that is the exit is extremely important to you, but it's stressful, not for you as the angel, but certainly for the board, and most importantly for the executive. And the fact that you hear the company's put itself up for sale doesn't mean you can expect a check in 3 months' time.
So, Richard, thank you. Did you want to talk very briefly about the waterfall, which is illustrated in the book in an extremely comprehensive way?
Yes.
The waterfall then allocates the proceeds relative to preference shares and so on.
Yes.
That's an important subject.
Well, and actually, you as an investor need to be understanding that sort of at all times as things change. When I say when things change, it's an issue of some new shares. What are their rules? And put it in. So the waterfall be, let's take the example of different amounts of money we might get for this company, and how are those proceeds allocated? So the first little bit will be to lawyers and an M&A agent, let's assume, so a little bit to at least be aware of. And then the question is, what happens next? Now, if it's a company that's got plain vanilla ordinary shares and nothing else, assuming there aren't debts and things like that, which complicate matters, and generally, certainly in early stage technology companies, you don't have debts. So you're offered 100, then 100 is going to be allocated to people. And if you've got 5% of the shares, you'll get 5. And if you've got 10% of the shares, you'll get 10. Soon as there are different rules, that may not be true. So a simple rule that I talk about in the book is where you have in your ordinary shares a rule that says, when there is liquidity, the first money you get back, Mr. Shareholder, is the amount you have spent on your ordinary shares. So Joe Blow, the founder, bought his shares for 1p. You, the first funder, paid £1. Me, a later funder, paid £5. So the first £6, 1p, adding those three up, goes to each of us, £5 to me, £1 to you, 1p to Joe. Then everybody gets the rest of the proceeds divided by the number of shares that they've got. That's an easy one. You might also find there's been some VC company has come in and they've got some sort of preferred ordinary share. And there are lots and lots of, again, you've got to be very careful with terminologies here. Lots and lots of descriptive words used, but they've got a share that says we always get our money back first, ahead of everybody else, before the rules to share equitably apply. So they're always taking the top slice. Now, when you interpret that lot, if you put a valuation on the company, you say, let's look at each class of share, how much does each get? You may find, being an angel and just in EIS shares, this company has to be sold for quite a lot of money before you get any at all. So you mustn't just assume, well, this mustn't be so great, but 5 million is not so bad, is it? You may find that actually that 5 million doesn't come to you at all. And the term that's used loosely to describe that process is waterfall. And I gave an example in the book of a company that I'm involved with, which is a particularly complex waterfall, which arises from the length of time it's taken to get where it is, the number of CEOs who've been through, the number of CFOs who've been through, all sorts of complicated stuff. And so now that we're looking to sell that business, there are very important questions. And as it happens, before ordinary shares who never took part in any other of the complicated fundings, if all they ever did was sit on their AIS ordinary shares from some time ago, they won't get money till that company's sold for quite a lot of money. Then they do start to cut in. So the waterfall is very important. And then let me just come back to another thing, which Dermot mentioned earlier, which is the issue of drag. Drag in the articles generally will be if a certain number of shareholders vote to sell the company, and the normal number is like 75%, the rest are obliged to sell, which stops the tiny investor saying, oh, I see Mr. Buyer, big quoted buyer wants 100% 0.00. I've got 0.1%. Everybody else agreed. They're going to have to pay me extra. I won't agree because I know the big company insists on owning all the shares. So the drag stops that happening. And when you get a complicated waterfall, you'll find the consent of each class of share is needed. So it's not quite as simple as just taking a 75% overall vote. And you can suddenly find people who've got more power than you thought they had. You have to be very, very careful of VCs in that regard. They like to have, I come from that background, and they like to have all the power. It's not to say they're going to be unfair. Some will, but it's not to say they are, but they will have all the power. So you need to be very, very careful you understand those things. And if you don't, you just say to the company, please, can you tell me how proceeds are divided when we sell the company for 20 million, for example?
So much of that is included actually in your chapter, What do I need to understand about the terms and instruments? Just to sort of cycle back to that. It's an amazing book from my perspective. I'm conscious of time, so I want to go to some questions, if I might, Richard. It's an amazing book, available on Amazon. It's great to read, so I encourage you to all get your own copies. Let's head to the questions, if I might. Constantine Gloomis, welcome and good morning, Constantine. If you have $1 million to invest, what is the right number of companies to spread the risk?
Well, in the book, I argue you should really seek to invest at least 10. Now, 10's a bit of an issy-butsy sort of number, but I do that on the basis the stats. And when I look at the surveys done by other people, British Business Bank and all sorts of people, I find my own stats, because I've done enough of these things, fit in quite neatly with that, where you find that you're going to lose 30-40% of your investments outright, get some of your money back or a little bit more on another sort of 30%, but you only really make big money on 20% or less. It's hard to see how that makes any sense unless you're doing at least 10. Now, my book uses a portfolio of 42, which was just from a point in time to a point in time I published the book. So I would recommend you think of doing at least 10. Then I do a little example in the book of this too, bearing in mind tax relief and all sorts of stuff. Whatever you do, if you've got £1 million, do not put 100,000 into 10 companies tomorrow, because all of a sudden you've got no money left. And by the way, as sure as eggs is eggs, that many of them are going to ask you for more money. So perhaps you invest half that money. Remember, if you're doing EIS, you're investing 70% of the 100 the company sees, because you're investing the 100 and then you claim the 30% back against tax. You've got to watch the cash flow. So you can build that into the equation. I'll do a little analysis in the book, but you must, I don't think you should invest more than 50% of your money in companies first time. In other words, the implication is you are prepared to invest more money in each one. And there's no easy answer, but for goodness sake, don't put £1 million into one company. You might become a multimillionaire, and you might simply become bankrupt.
So the place to go in the book for further illustration is all about covers the whole concept of portfolio building in theory. So there is it's called Modern Portfolio Theory in the book. So it's a great place to go and pick up more reference on that. Can I move to the next question? So if a company gets a majority strategic investor looking to buy a majority stake in a company, it may provide an exit point for an angel investors. So who and how determines if the angel investors can exit at that point?
All right, well, the starting point is the board, which is one of the reasons I say that you do really want your group to have somebody on that board who cares about you as a group of investors. We don't just want the executives and a VC on a board. And there are a lot of different answers. What happened a lot latterly, I don't mean in the recent crash. I mean, when more and more money was going into this world, before the market rather turned, because the thing got a bit carried away, a common thing as companies raised more money was to say, well, this company's doing rather well. I, the VC, would like to invest 20 million. And the company says, we don't want 20 million. And by the way, we don't want the 20% dilution that comes with it. So the VC says, well, all right, tell you what, I'll invest 10 million and I'll offer 10 million to the existing shareholders. And what he might do is to say, I'll offer you 10 million into the company at a valuation of, I'm making these numbers up, 30 million, but I'll buy at a valuation of 20 million. So I'm averaging my price down a bit. So I'm prepared to pay quite a nice price to go in and a decent price to take some money out. The normal rules would then be, which will be determined by these articles, which you've all read by now, will then be that there's 10 million available at a certain price. Who would like to sell some shares? Anybody or everybody can put their hands up. And if everybody puts their hands up saying, I'll have the maximum I can have, you will all get your equity percentage. It won't work like that because some people won't be selling, for example, and some people might want to sell more than their stake. So that's a possibility. And I have a company that it was a fintech, which is kind of by the by really. And it was bought by Santander for something like, assuming they bought the whole of it, for something like 700 million, a lot of money. And Santander bought half on the basis there'll be some rules about buying the rest later. These rules are not very clearly obvious to the smaller investor like me. And we still don't know what the final answer will be, but Santander has been back once and said, oh, we're going to buy some more of these shares. So we now own 30% of the company that we used to own 100% of. But you expect the board's job is to come up with a formula on that makes sense, that treats everybody, the shareholders, properly. At the end of the day, the shareholders are going to have to vote on that. The sorts of things we're talking about probably need some sort of shareholder vote. And so there is an opportunity to say your piece if you don't think you're being treated fairly.
Very good, thank you. Nicholas, I hope that answers your question. Can I move to the next question, Richard? So question about getting loss relief from a zombie company. Would a sale of the shares at zero value for the instance that founders satisfy HMRC? I think that's clear from
yes, that will work. What doesn't work is to go to HMRC and say this company is clearly worthless. Here are its accounts. Therefore, I want to value my shares at zero. Please can I claim loss relief? They'll tell you to go jump in the lake. To sell your shares for me, and I buy them all for £1. Well, if I had to argue with you, now don't have any shares, you've raised £1 and you invested 10,000, so you've just lost 999 £1,999. So that works, but and there are one or two people who are starting to offer that as a service. There are one or two people you can find when you poke around online who, deliberately offering a service to allow you to crystallize losses. Because if you know you've got a loss, hey, you'd like it back in cash and you can reinvest it or go for lunch with it or whatever. But that is the worry with an EIS loss, if you like, that you get stuck in a zombie. So you know your investment's worthless, but you can't actually claim the loss relief. So you have to work at it a bit. But there are increasingly people who will offer that, or don't do it with a family member, but get your mate down the golf club to buy your shares for £1. Give him the £1 and tell him to buy your shares for £1.
Very good, thank you. In fact, stakeholders, as one of our investors is in fact director in JP Jenkins, which actually does just that. Yes. Very well established and highly respected city name. May I bring up the next question then from Andrew Gerard? Do you recommend any external forms of seeking industry-specific knowledge and reassurance, or is it a matter of using your own networks and contacts?
Well, again, look, let's come back to the syndication stuff we said earlier. If you're involved in a group process and there's a syndicate organizer, an angel group, you'd expect them to do some of that. And I've just invested in something which is, in market terms, miles out. I mean, I've just broken my own rules here. It was miles outside the market I operate, which is basically business software. And yet it was massively disruptive, really massively disruptive. And I managed to have conversations with people who really knew that industry. And I did some due diligence because I brought in a government fund alongside me, and I did some serious due diligence speaking to potential customers of this groundbreaking product. And that made it absolutely clear that this was disruptive, highly attractive, and the fear that we as naive investors had was, hang on a minute, the big boys will just say, hey, we don't like this, but crush it to death. And actually what came out of the due diligence was, no, that's not what would happen at all. So yeah, whatever you do, don't go into something you don't understand and you've got no means of validating whatsoever. All you can do is believe the CEO. Well, the CEO may be honest, he may be dishonest, but he may be honest, but he's carried away his own enthusiasm. So you're always going to get the gold version of the story. So yeah, you must find some way, I think, of having some sort of reassurance that this does make sense in that industry, because there are people who will understand that industry. But don't go and employ your own experts. Somebody else will be doing that.
Very good, thank you. And Andrew, thank you on that. And thank you also for your next question. You mentioned various criteria for looking at deals. So have you ever broken your own rules, and can you talk about when and why? And have you ever lived to regret the change?
Well, to answer the last bit first, yes, of course I have. Have I broken my rules? Yes, of course I have. And I just gave you an example. And remember, I'm in business to business software. The example I was just talking to, let me just actually tell you what it is. This is going to sound really, really silly. It makes machines that make corrugated cardboard. We all buy corrugated cardboard wrapped around our nice Amazon product, whatever it is. And that is a product that is horrendously expensive to make. It's made with a steam-driven process. The glue is steam-driven. When you ship corrugated cardboard, you're mostly shipping air. And these guys have got patents on a cold glue process. Saves, before the price rises in gas, it was saving 80% of the manufacturing costs. Yeah. Now, it's not going to compete with the people producing very, 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 very big pieces of cardboard for very, very big industrial packaging. But when you look at the whole retail world, which is increasingly driven by retail cardboard boxes, it's dramatically different. And so I just looked at this and I thought, wait a minute, these guys have been working at this for 8 years. People put their money in 8 years ago when it was a guy with a little glint in his eye. He's now got patents. He's got a manufacturer in Germany who is the professional maker of this kind of kit, who absolutely loves it. He's got several people already say, we must have this product, which is also, by the way, instead of being, you're not going to believe these numbers, but instead of being 100 meters long, which the big kit is, this thing's 10 meters long. So instead of having to build a whole building to put it in, you can put it in a room. And therefore it could be sited close to where the cardboard boxes are needed, and therefore you're not shipping the stuff. You know, so I looked at that and thought, this is just the most disruptive thing I've ever seen. Now, as it happens, in that case, there were on the board 2 people who are deep experts in this industry. And so I gained a huge amount of confidence. So that one, the jury's out, because I've written my check, but I made the first board meeting, so the jury's out. When I look back, as I did for the writing the book, went back over the 42 investments that I made. Some of them I thought, gee whiz, what the hell was I doing that? And there were always reasons, but I think getting into more of a focus, getting into an area that I started by with some understanding and then developed more understanding, and had the ability to make introductions and so on. There's no question my performance has increased by narrowing the focus. All right, once in a while, and this example I've just given you was the once in a while, I've completely broken the rule. But I think, you know, the rules are there to, experience says you should be using the rules, but that's not to say you shouldn't occasionally have a night out, as it were.
Yeah, very good. Well, Richard, thank you so much. In discussing the preparation of this webinar, we did also discuss the medium, and you have clearly stated your preference for face-to-face and theatre style presentations. So I'd like to put out a challenge to the audience, and I'd like you, if you would like us to set up a theatre style presentation about the book and bring Richard in to give a full-blown, you know, talk on the book at his own pace without interviewing questions, please do let us know by email. There is no poll associated with this today, so we're not going to ask you the question outright. You must hit the email. And if you give us the bit of homework, we will actually then go to work and set up an event. Not sure when yet, but hopefully it will all happen by Christmas. So it would be really good to get your feedback, and your feedback more generally on this event. I hope you go out and, in fact, rush out and buy the book. And it remains for me finally to say, Richard, thank you so much for your huge depth of insight and experience and the way you've delivered it this morning. It's been really interesting for us all.
You are very welcome to that. And if that event should happen, one of you feel free then to say, how is your investment in corrugated cardboard going? And I'll be forced to either say it was a brilliant decision, or gee whiz, maybe that wasn't such a clever idea.
Very good. Well, with that, lots of compliments coming in. Tim, thank you. So really useful, but we'll pick all of those up from email. With that, final thank you then to Richard, and thank you all indeed for attending this morning's event. So I shall say au revoir, hopefully to seeing you all at the next face-to-face theatre style event. Do let us know. Many thanks. Bye for now.
Thank you very much. Goodbye.